So as of January 12th, depending on when this video is released, it's most likely the Fed's most recent meeting at the time. The Federal Reserve is putting a serious dent into inflation's growth. And according to many major institutions and other large companies and CEOs, the Federal Reserve has basically made its point and should stop raising interest rates. In some cases, some are arguing that the Fed should be cutting interest rates already. So what is this conversation and what do these data points have to do with you being able to take what's going on right now in the economy and actually make some financial moves and some investment moves that can set your kids or any dependent children or nieces or nephews or grandkids up for tremendous success without having to punch a clock and work extra hours and save a bunch of extra money to do so? We're going to talk about it in this video. This is JP from Blueprint for Prosperity, helping you to increase your net worth through relationship banking, maximizing your borrowing capacity, proper use of life insurance, and the ownership of real estate. I want you to like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity. So, as I already directed in the earlier portion of this video in the intro, the Federal Reserve is having a serious impact on inflation. Inflation is still very high, and in some cases, it's still growing, but it is growing significantly slower consistently for the last 6 months since the Federal Reserve has decided to take action in the second quarter of 2022. So with these effective rate hikes putting a dent in inflation and it's trending downward, many major companies and corporations are barking at the Federal Reserve to stop raising interest rates and possibly even start cutting them. And the moral of this story for them is that their incentive as these major corporations and institutions are significantly different than the focus of the Federal Reserve and the people they serve, the general public more so. And those two focal points are clashing with each other. The Federal Reserve's job is to balance out the economy and balance it out for the short and long term. Keep inflation at a reasonable rate, which they consider 2% inflation per year, and to keep the economy and the long-term health of the economy in a healthy place. With inflation sky high, the Federal Reserve has no choice to protect the long-term health of the economy, but to fight inflation and to give it a really hard fight for an extended period of time or as long as it takes. Major companies, corporations, and institutions have a different set of focuses. Their focus is going to be a lot more around the cost of money for them to be able to operate their businesses. So when the Federal Reserve raises rates, making money more expensive to borrow, this puts a serious dent in the growth and functionality of many major companies and corporations. And it also can put a dent in the industries they function in because they're dependent on consumers to buy their goods and services. And the Federal Reserve increasing rates reduces the average consumer's economic participation. So with that having been said, the likelihood that I can foresee and some other professionals and analysts can see is that the Federal Reserve is very serious about continuing their fight against inflation. That means that the next 1, 2, possibly even 3 meetings coming up in February, March, and beyond could still have rate hikes in them. Not only will the Federal Reserve not lower rates or even flatten them out, they could still raise rates the next couple meetings that they have coming up. And at that point, maybe another 1 or 2 rate hikes may come in from the Federal Reserve to make sure they have put a definitive dent into inflation. Then they may stabilize the rates. Where does this tie in to the opportunity that may be available for you? And I tie this in this particular video to kids that you may be, your own kids, or again, nieces, nephews, grandkids, godchildren, whoever. Your opportunity to make one major investment financial move and give your kids or give these kids an opportunity to have a great financial future in relatively uncertain times in the next decade or so. The Federal Reserve even though they're aggressively raising rates, the 10-year treasury, which is much more directly tied to mortgage rates, has actually been dropping precipitously. And in the process of doing so, it's bringing mortgage rates down with it. But for several weeks now, mortgage rates have been trending downwards, which has had an interesting effect on the housing market, or maybe will have an interesting effect. Even with the Federal Reserve raising interest rates, at some point, likely by the second quarter or so of the year, they're probably going to raise a couple of times and flatten out. So with mortgage rates already trending downward and the Federal Reserve pausing rate hikes, this is likely going to stimulate mortgage rates to drop down even further. It's not a guarantee, but this is likely how this is going to play out sometime in the second to third quarter of this year. So what this means is that this could be a phenomenal opportunity for those of you who may be right on the sidelines of getting back into the real estate market, particularly real estate investors for the sake of this conversation, or those of you who are willing to buy at least your first rental property, and you would like to use it to fund your kids or grandkids or niece or nephew's godchildren's future. Interest rates could potentially go below sub 6 or even lower if all plays out the same. If the Federal Reserve flattens out their rate hikes in the next coming months and the 10-year treasury continues to trend downward and pull mortgage rates down with it, you could be looking at a phenomenal opportunity to get back into real estate or get into real estate at, again, relatively low interest rates. Not historically low like it was 2 years ago, but still significantly low. Upper 4s, upper 5s. These are great rates in the grander scheme of things. This could open the door for many of you to buy a rental property while the market is cooling down and rates are still coming down at the same time before the market starts to heat back up from rates coming back down. If you're following what I'm saying, I'll say that again. This is an opportunity where the market is already cooling down from the rate hikes that we've had last year, but rates are trending downward at the same time. So it's becoming a buyer's market and affordability will start to increase. This could be your opportunity to go out there and buy that rental property. And in this scenario, I'm going to paint it as a picture for an opportunity for you to invest in any kids that you have in the family's futures. Because what you can do is now this increased affordability when buying an investment property is going to actually benefit your net cash flow. Because your interest rates are down, the servicing of debt on that rental property is going to come down with it. So that means you're going to have a better net cash flow on that property. What I'm saying is a great strategy, and just to put this kind of concept on your mind, is you could have an opportunity here in 2023 to take down a great rental property that has a reasonable cash flow, take that income from the cash flow from that rental property, funnel it into the stock market in an ETF or some kind of broad index fund. Doesn't have to be anything complicated, because yes, the stock market is down and it may trend downward for the rest of 2023. But the reality of it is, at some point in the coming months or year or so, the stock market will recover. It has to. It's too important to our economy. And you could be investing in right now, dollar cost averaging your way into the stock market with income from this rental property right now that can be growing without you having to punch a clock or constantly contribute to that growth of that index fund or that ETF, while that rental property is paying for itself, giving you tax benefits, growing in equity likely at some point in time, if not immediately, and having an increase in rents, which is something that has almost always gone on in the real estate market. Rents always go up, hardly ever come down. So you could be getting a 3 to 4-fold return on your rental property, funneling that excess cash into the stock market, into a broad-based index fund or ETF or a really good mutual fund. You can do your homework, whatever makes sense for you. But instead of having to contribute your hard-earned cash, you're letting the rental property funnel into this investment product, the stock market, this index fund, and grow. And then you can gift this out over time. So think about this for a second. You have a rental property that's likely going to grow in equity. It's going to grow in cash flow from rent increases. It's giving you tax benefits and it's paying for itself. You're getting a mortgage pay down. And on top of that, the cash flow, because you don't need it, you're stable on your own and you're doing this for the future of your kids, grandkids, whoever. You're likely going to have 6, 8, 10, 12, 15, 14 years, depending on the age of the child that you're trying to do this for, of that rental property funneling into that stock market investment, and that growing all that time, tax deferred, and that goose egg keeping up with inflation or possibly beating out inflation, all without you having to contribute a penny of your own money. Can you think about how amazing that return could potentially be and what kind of gift that could be? Just one rental property going into one stock market investment fund, set up a brokerage and just pick it, do your homework, pick an index fund, ETF, whatever makes sense, and watch it grow and compound over the course of the next 6, 8, 10, or 12 years, whatever window of time that you have before that child becomes an adult and you're ready to gift those two investments to that child. That rental property, even if we pick 10 years and we just pick 3% equity, 3% rent growth, that's 30% more rent coming in from when you bought it, 30% more equity in the property. That's not including talking about the mortgage pay down, the tax benefits you save. And again, you have a stock portfolio now that's been building up with $200, $300, or $400 a month for 10 years in principal, not to mention it potentially averaging 5, 6, 7, 8, or 9% return over the course of that 10 years, averaged out per year. You can do the math on this. This is a phenomenal investment opportunity. And this all could be sourced from great rates that could be coming here in 2023. It's time to get creative. If you want to build a better future for your kids, if you want an opportunity to give them a better opportunity in going into their adult lives, this is the kind of strategy that you need to be putting in place. And it can all happen for you this year. If you have your ducks in a row financially, you're ready to go out and get a quality loan from a bank, a local bank or institution, find a quality property. You just need one. Think about this strategy. You just need one. Just one. You can make a 6-figure difference in the life of your child or children or whoever, whatever young person in your family that you're looking to benefit and gift as they get older. So this is the kind of creativity we're creating on this channel. This is what I want you to deploy to increase your quality of life and the quality of life of future generations. Thank y'all for tuning in. I enjoyed bringing you this content. This is JP checking out. I want y'all to stay focused, stay in motion. I'll see y'all soon.